Hi everyone, and welcome back to ACCAP 4 live session 5. According to the study planner, we're supposed to be doing international investment appraisals and valuations, acquisitions, and measures session 1. But as we all know, we haven't finished the cost of capital and adjusted present values. So I'm quickly going to go through them, and hopefully by next week, we should be online, hopefully. Okay, so I'm going straight to where we stopped last time. Last week, we were doing the cost of capital, and we said where business risks and financial risks are changing significantly, the WACC should also change. And we calculated project-specific cost of capital on the basis that if your activities is different from the main activities, then your business risk has changed. Another way you can see business risk changing is where the company is moving towards a new industry. So the moment the company is diversifying from its main activities, its business risk will change. Financial risk will change when your debt equity proportion also change. So anytime you read the question and your debt equity proportion is going to change, or your business risk is going to change as a result of diversifying to do a new activity, your WACC should change. In that case, the new WACC we have to calculate is what is called the project-specific WACC. And that is what we did last week. We said you would have to look for a proxy beta. If that proxy beta is geared because it's measuring both business and financial risk, there will be the need for you to remove that financial risk. And as such, you have to ungear to get the asset beta, which measures only the business risk. If you assume that business risk, you ask yourself, is your company having debt? If your company is having debt, then obviously they are having financial risk. So therefore, there will be the need for you to re-gear. When you re-gear, you will get the beta that measures your business and financial risk associated with that particular project or activity. Put it in the capping, and then you get a cost of equity. Finally, put it in the WACC formula, and then you should get the project-specific WACC. And that is what you would need for the purpose of discounting the cash flows associated with a new project. So today, let's go straight to WACC of combined activities. We're going to pick it from there, WACC of combined activities. Whatever WACC they ask you to calculate is all about issue of that WACC should reflect the business risk and financial risk. So when they ask us to calculate WACC, you would have to be leading yourself. What WACC am I supposed to calculate? Am I supposed to calculate my normal WACC? And that can happen only when business risk and financial risk are not changing. Okay? What WACC again, if business risk alone or financial risk alone is changing or both are changing, you need that project-specific WACC. The next level of WACC the examiner might ask you to calculate is what is called the WACC of combined activities. And obviously, the examiner is not going to tell you calculate the WACC of combined activities. He created a scenario. You would have to know that this is an application of WACC of combined activities. And what is the situation? As the name suggests, combined activities. So you will calculate the WACC of a company when the company is doing more than one activities. For instance, the company is in the education industry. At the same time, the company is in the mining industry. What will be the company's overall WACC? Okay, as long as they are doing more than one activity in different industries, that brings the definition of WACC of combined activities. How will you calculate it? We all learned that whatever the WACC is, it should reflect business risk and financial risk. So for instance, if the company is in the education industry and at the same time they're doing something too in the mining, okay, I don't need a WACC to discount cash flows associated with education alone. I don't need a WACC associated with mining. If I needed works associated with education alone, I will calculate project-specific work for education. I will also calculate project-specific work for mining separately. But when I want the company's overall cost of capital, it should be the combination of these two. And how will I get that? Work should reflect business and financial risk, so that my work of the combined activity should reflect the business risk and the financial risk of the company. What will be the business risk of the company? Because the company is doing two activities, mining and education, their business risk will be the business risk of those industries. So I need to get business risk associated with the education. Okay, my business risk associated with the education, and I also have to get the business risk associated with the mining. Obviously, financial risk is not the issue. Financial risk is the company's debt and what? Equity. So the issue here is how to get the business risk and business risk of the different activities the company is undertaking. So your overall business risk should be the business risk of all the activities that you are undertaking. So if I want the business risk of the education industry, as usual, I have to go to the education industry and look for a beta. When I pick a beta in the education industry, that is the proxy beta. It follows the same stages as the project specific. So if I pick the beta in the education industry, I also go to the mining industry, pick a beta. That is what we're going to call as a proxy. I'm explaining the stages in your note. So go to each of the industries the company is undertaking the activities and look for a proxy beta. If that proxy beta is geared, you would have to ungear it. So you are going to have two ungeared betas if the company is doing two activities. So you go to the education, you go to the mining, you pick betas in there. That becomes the proxy beta. If those proxy betas are geared, you would have to ungear to determine the asset beta. When I get the asset beta of education and asset beta of the mining, it's measuring the business risk in that industries. And as such, what will be my overall beta, or what will be the overall asset beta measuring the company's business risk? Because the company's business risk is this and that, the overall company's business risk or asset beta will be the weighted average of these two asset betas of the activities that you are undertaking. So when you get the asset beta of the first activity, asset beta of the second activity, the company's overall asset beta will be the weighted average of these two, because the company is not doing 100% of education, 100% of the mining. So the examiner should give you the basis for you to calculate the values of each of the activities. You use it to calculate the weighted average asset beta, and that will give you the asset beta measuring the business risk of the whole company. Then you ask your company, have you got debt? If they have got debt, what is their debt equity proportion? You use it to re-gear, put it in the capping, put it in the work, and you get the work of the combined activities. So it follows the same stages as the project specific cost of capital. The only difference here is that here, because you have got more than one activity, you have more than one business risk. So you need to get more than one asset beta. And the moment you get all the asset betas, your overall asset beta should be the weighted average. So if you go to your note, these are the stages they have given to you. First, identify the proxy beta from each of the industries in which the activity is being undertaken, and gear each of the betas if the betas were geared, and then you will get the asset beta for each of the industries. Here they said calculate the market value, because we are leading you towards the combined asset beta, and the combined asset beta is the weighted average of all the asset betas of the activities. You have to weigh them on the basis of their market values. That's why they said calculate the market value of each activity. Then find the weighted average asset beta. That is what they normally call in the combined asset beta. And if you get a combined asset beta, if your company is having debt, you re-gear it, you cap it, and then finally you calculate the work of the combined activity. So simple, let's go and take this example to illustrate. Okay, let's take this example to illustrate. For some of you who have done the progress test 1, I think this application was there. Okay, the progress test 1, you wanted the project specific cost of capital there. They gave you a proxy company, and that proxy company was doing 2 activities, doing component activities and other activities. And as long as that company is doing 2 activities, their equity beta is the beta of the combined plus the financial risk. So this is the application you need here. This question here is a past question that they actually summarize it. So let's take this question to illustrate. Bigande PLC provide training and financial services. The training services account for 2/3 of the value of the company. I'm going to tell you to put a full stop here. Okay, so let's say the training services account for the 2/3 of the value of the company, and then put a full stop here. Let's change it. The total value of the company's debt. Okay, so let's change here. I'm changing this. We're saying the company's debt to total market value. So I'm changing because I will explain why. The company's debt to total market value ratio is 30%. So debt of the total company is 30%. The average beta and the debt to total market value for the financial service sector are 0.9 and 25%. The average beta and debt to total market value for the training service sector are 1.5 and 12%. Other information, the equity risk premium is 3.5 and the rate of return on short-dated government stock is 4.5. Bigande PLC can borrow at 2.5% above the risk-free rate. Tax on corporate profit is 40%. Assume that debt is risk-free. Estimate the cost of equity capital and the weighted average cost of capital for Bigande PLC. Okay, this is how the question will come. I have to calculate cost of equity. I have to calculate WACC. Which WACC? Okay, I'm calculating the WACC of the whole company. Calculating the WACC of the whole company is not for a project. So I don't need a specific project. I need for the whole company. This company, according to the question, is doing training and financial services. As long as they are doing training and financial services, obviously they are doing more than one activity. So their WACC should be the combination of the business risk of the 2 activities and their financial risk. So that is the argument. So what should we do? We have to go to each of those industries and look for a beta. They've told us the average beta and debt to total market value for the financial service sector are 0.9 and 25. So I have to go to the financial service sector and pick a beta. I also have to go to the training service sector and pick a beta. And these betas are asked, are they geared or ungeared? Because all of them are having debt, then they are geared. If they are geared, it means it's measuring the business risk and financial risk of each of the industries. I am not interested in the financial risk in the industry. I'm only looking for the business risk because all of us in the industry faces the same business risk. So that is what we did here for you. So we pick the beta for each of them. Okay, so go to each of the industries and look for a proxy beta. If those proxy betas are geared, you would have to ungear. And we all know that according to Miller and Modigliani, if debt is assumed to be risk-free, your asset beta should be equals to your equity beta geared, equity over equity plus debt, 1 minus the tax rate. Okay, because debt is assumed to be risk-free, so everything there is going to be 0. So when you take the financial service sector, what will be their asset beta? That is measuring only business risk. Their equity beta geared is 0.9. Question told us their debt to total market value is 25%. Therefore, their equity should be 75%. This is the formula we are actually substituting. Tax rate, according to the question, is 40%, 60%. You solve it mathematically, you have to come and get the 0.75. You do the same thing for the training sector. The training sector, there is a beta equity of 1.5. What will be their asset beta? They are 1.5 multiplied by their equity. Question said their equity, okay, their debt to total market value here, is it 12%? So if it is 12%, it means their equity should be 88%. 88, 12% tax rate off, and you have got the asset beta. So this is measuring the business risk in the financial sector, and this is also measuring the business risk in the training sector. What will be my overall business risk? I have to face these two business risks as a company because I'm doing the two. And as such, my business risk overall is not this plus that. No, it's not that plus that, because you don't do 100% of this, you don't do 100% of that. It's just the same as you calculating work. It becomes the weighted average, and the weighted average should be done on the basis of the values of each of them. So what are the values of each of them? Question told us that the training sector, if you are here, the training service account for 2/3 of the value of the company. So if it's accounting for 2/3 and we are doing training and financing, then financing will account for 1/3. That is why your stages were telling you calculate the values of each of them. So we have got 1/3 for the financing and 2/3 for the training. I need the weighted average beta. That combined asset beta should be the weighted average of the asset beta of each of them, weighting using their respective values. And these are the respective values. So the financial sector account for 1/3. Its asset beta is 0.75. The training sector account for 2/3. Its asset beta is 1.387. So it means the whole business risk associated with the company is equal to 1.175. Then you ask yourself, if this is the combined asset beta, they normally do it this way. If this is the combined asset beta, this is the business risk my company will face. Then I ask, company, have you got debt? If the company has got debt, then we are going to have a financial risk. And that is why I changed this one here. Because if you continue, it sounds like the training service account for 2/3 of the value of the company and has a debt to total market value ratio of 30%. No. What they want to imply here is that the whole company is having a debt to total market value ratio of 30%. So it means if the whole company is having debt of 30%, the company whole is also having equity of 70%. Okay, so if we have got debt of 30%, then we have to bring our financial risk. That is where we need to re-gear. And we all know the re-gear formula, the same as the asset beta formula. So giving me my combined asset beta of 1.175, what will be my equity beta geared? My equity is 70/30 debt and then tax, and this one will bring me to my cost of, my equity beta geared. Now this equity beta is measuring the company's overall business risk and the company's overall financial risk, and that is the risk that we are facing. Therefore, put it in the CAPM to get your combined cost of equity. And we put it in the CAPM. They said risk-free rate is 4.5. Your beta you got is 1.48. Equity risk premium. It means they have already deducted the risk-free from the market return. He said it's 3.5%, and then you will multiply, solve it that mathematically, and then you will get the cost of equity of the combined. What will be the work of the combined? Cost of equity of the combined, cost of debt of the combined, weighted on the basis of debt equity proportion. Okay, they told us our equity represents 70, our debt represents 30%. Our cost of equity we've got as 9.68%. Okay, what is the cost of debt? Examiner said in the question that Gigande PLC can borrow at 2.5 above the risk-free rate. So if it's above the risk-free rate, then if the risk-free rate is the government security rate, we said it's not always the examiner will say risk-free rate. Here it says short-dated government word stock. Government securities are assumed to be risk-free. So if the risk-free rate is 4.5 and you borrow at a premium of 2.5 above the risk-free rate, then your cost of debt should be the addition of the two. So 4.5 plus 2.5 should give you the 7% they put there. So that is the 7%. And that 7%, don't forget that is gross. So you have to knock off the tax effect and you will get your WACC. And this is the overall WACC of the company. This is the overall cost of capital of the company. And this is not what we need to finance or use as a discount factor to calculate MPV for the training, nor for the MPV for the financing services. No, this is the company's overall WACC. Okay, if I need to appraise investment associated with the financing, I need to go and calculate project specific cost for it. I wouldn't need anything from the training. If I want to do something for the training, I wouldn't need anything from the financing. So you should be able to separate the two. So this is basically how we will calculate the WACC of the combined activities. So please read the assumptions and limitations of capping. Nobody cares so much about that, but you can take about 2 minutes or so to read through it. So I am moving you straight forward to the next chapter, which is adjusted present value, chapter number 7. Adjusted present value. What can I say about adjusted present value? I wouldn't be surprised at all for you to see adjusted present value in your exams. If I have to say, when we started the investment appraisal, we said there are so many methods that could be used to appraise investment. There are so many methods. We have learned the MPV, internal rate of return, discounted payback period, duration, modified internal rate of return, profitability index when we're doing the capital rationing. Now, the next, or if I have to say, so far as your syllabus is concerned, the last investment appraisal technique we need to know according to our syllabus is the adjusted present value. And to be honest, it has been the most common technique being asked in P4 exams. It's normally MPV or adjusted present value. The last time it was tested was the June 2014. Okay, June 2014. I wouldn't be surprised at all. Even if it's not tested as investment appraisals, you need its application when we go to measures and acquisitions. So you cannot go to the exam room without adjusted present values. What is adjusted present values? If you have followed the argument we've developed and the investment appraisal techniques, we criticize internal rate of return on the assumption that the reinvestment, internal rate of return says the cash flows will be reinvested at the internal rate of return, and that was very optimistic. So internal rate of return was conflicting with MPV. So we introduced the modified internal rate of return. So the criticism of the internal rate of return brought the modified internal rate of return. We all also know that the criticism of the payback period brought about discounted payback period. And discounted payback period was also criticized, that even though you take into consideration the time value of money, you don't look at all the cash flows associated with the project. Therefore, we introduce the duration, which we know how to calculate all of that. Now, the next criticism was on the MPV. MPV was criticized. The criticism based on the MPV brought about this adjusted present value. Why that criticism? We've all done cost of capital, and we concluded that whatever discount factor we have to use to appraise the investment or to discount any cash flow should be consistent with the risk that goes with that particular cash flow. So if I'm diversifying into a different industry, I cannot use my current WACC. I have to use a WACC which is consistent with the risk that goes with the cash flows. That is where we did the project specific cost of capital. And when we got the WACC, we discounted the cash flows with the WACC, got your MPV, which sounds a very good argument. But adjusted present value is criticizing that WACC, telling you that the cash flows that we get, sales, variable cost, fixed cost, tax savings on capital allowance, working capital, when you come and get that net cash flow is not coming as a result of the method of financing. That cash flow is coming as a result of operations, and operations relates to the business risk. So if I have to get the net cash flows and I have to discount it using a WACC, which had taken care of financial risk. I am not comparing like against like, because the net cash flows are from operations. Therefore, the net cash flows are associated with risk governing operations. It is not having any risk governing the method of financing. So I do not have to discount the cash flows using a WACC that includes financial risk, because those cash flows are coming from operations, they are not coming from financing. Therefore, APV, or adjusted present value, is simply telling you when you are developing the cash flows, you would have to separate the cash flows into those cash flows that are coming from operations and those cash flows which are coming from financing, so that the cash flows coming from operations will be discounted using cost of capital associated with the risk that goes with operations, and cash flows coming from financing will also be discounted using the discount factor that is associated with the method of finance. So APV is said to be the divide and conquer approach, because we've all concluded in cost of capital that at the cost of capital you need as a discount factor to discount every cash flow should be consistent with the risk that goes with it. Sales that I will get has got nothing to do with whether I'm financing the activity with debt equity or not. So why should I discount sales figures with WACC, which take care of both both business and financial risk? I am not comparing like against like. Okay, so that is the case. Now let's go to the calculation of APV. If you see the question, an examiner is asking you to calculate APV. So far as I'm concerned, I would like that one than even MPV. Okay, so I'm going to do the flow chart as I normally do it for you. I want you to put yourself in a framework. You go through the exam room, you read the question, and then you try to look at the framework that somebody told me, Fred, don't call it framework these days, call it a map. So that when I go to the exam room, I'm going to follow the map to get to my destination. So when they ask you to calculate APV, this is what you would have to be doing. Okay, so be with me. So when they ask me to calculate APV, APV is calculated as the base case NPV plus or minus present value of the finance effect cash flows. We said APV says separate business. This is the business bit from the financing, so that business cash flows will be discounted using discount factor associated with only business risk, and finance cash flows will also be discounted using discount factor associated with financing risk, so that we compare like against like. That's why they say divide them. Separate business cash flows from financing cash flows. How will I get the base case MPV? The base case MPV is your relevant net cash flows. Your relevant net cash flows, as we would do sales, variable cost, specific fixed cost, tax savings on capital allowance, initial investment, residual value, working capital. You come and get the net cash flows. When you get then that net cash flow is coming as a result of operations. So if it's coming as a result of operations, it is having only business risk. So I have to discount it using a cost of capital, which is measuring only business risk or compensating only business risk. And last week we all said the cost of capital that will compensate only business risk is when the company is all equity, and as such, when the company is having only business risk, their cost of capital WACC will be the same as the cost of equity and geared. Let me bring your mind on. When we were doing these diagrams, we said when gearing is 0, your cost of equity will compensate for only business risk. And when it's compensating for that business risk, equity holders will demand this. And at that point, your cost of equity will be the same as your WACC. So if these cash flows are coming from business operations, then I need to discount it using the cost of equity and geared. the cost of equity and geared, because cost of equity and geared measures only what? Business risk. How will I calculate the cost of equity and geared? I'm taking you through the way you are answering the question. When they tell me to calculate APV, I need my base case MPV. How will I get it? Question, give me relevant net cash flows. Go through sales, variable costs up to your net cash flows. And when I get a net cash flows, what technique is APV? I need to discount using cost of equity and geared. How will I calculate the cost of equity and geared? Examiner might push you into two ways. Either you are using the preposition approach, and last week we all said Miller and Modigliani preposition 2 deals with cost of equity. I'm summarizing all of that for you. If you look at the note, it's prepared on the assumption that we have already taught you this. We are not teaching you again, but I want to do all of them on just a flow chart for you. So when they give me a cost of equity of a proxy company and the cost of equity is geared, I don't need this cost of equity geared, because what I need here is the cost of equity and geared. Giving me cost of equity geared. If I want cost of equity and geared, I would have to think of Miller and Modigliani preposition 2. And preposition 2 is saying cost of equity geared is equals to cost of equity and geared plus cost of equity and geared minus cost of debt. Debt 1 minus T divided by equity. We've made this formula before. I'm just linking them. Okay? 2. The examiner can also give me WACC geared. When he gives me WACC geared, I can't use preposition 2. WACC is for preposition 3. Okay, and that preposition 3, which is the WACC, is saying that the WACC of the geared is equals to the WACC of the ungeared multiplied by 1 minus dt divided by E plus D. We saw all these formulas last week. Okay, and we all said that when the company is all equity, its cost of equity ungeared is the same as the WACC of ungeared. So this is the WACC of the ungeared. So common sense here is that if the question in front of me, the examiner had given me WACC of the geared, I need the cost of equity ungeared, which is the same as the WACC of the ungeared. So I can put them in this formula and I'll be able to get the other one. Any one given with the other information, you should be able to get the other. So giving me WACC of geared, I should be able to use preposition 3 to get the WACC of ungeared. Giving me cost of equity geared, because I want cost of equity ungeared, I will put it in preposition 2 to bring the cost of equity ungeared. The second way examiner can tell you, instead of giving you cost of equity and WACC, he will give you beta. When you read the question and you see beta, okay, we need the cost of equity and geared associated with the business risk of that particular project we're going to do. So same argument. If the examiner gives you a beta in the question, then he is not expecting you to be on this line, preposition line. He's expecting you to be with betas. And as such, go and look for the proxy beta. Look for that proxy beta. If I pick that proxy beta from the industry, the new project is supposed to be undertaken. I ask myself, this proxy beta, are you geared or ungeared? If the proxy beta is geared, it's measuring both business and financial risk. I'm not interested in the financial risk. I'm interested in only the business risk. So I would have to ungear. When I ungear, I get the asset beta. That is measuring only the business risk. Now, point of attention, please be with me here, because this area, many students get confused. Okay, so get it once and for all. What cost of equity are you looking for? We are looking for cost of equity ungeared. And cost of equity ungeared measures only business risk. So when I ungear the asset beta, whether my company is geared or ungeared, as long as I need the cost of equity ungeared, I have to put the ungeared beta or the asset beta straight into CAPM. And that will give me my cost of equity ungeared. When I was teaching CAPM last week, I said that Capping is used to calculate the return, not only cost of equity. The determining factor is the beta you put in there. So when I put equity beta geared in the capping formula, it should give me cost of equity geared. If I put in equity beta ungeared or the asset beta in the capping formula, it should give me the cost of equity ungeared. So when you are doing APV, because you need the cost of equity ungeared, please remember, you are not supposed to re-gear. No way. You are not supposed to re-gear. We re-gear in order to bring the financial risk, but we have concluded that the cash flows here has got nothing to do with financial risk. It's got something to do with only business risk. So when you get the proxy beta and it is geared, ungear it. The moment you ungear it, put it in the capping formula, and that will give you the cost of equity ungeared. And that is what you use to multiply this. That is what you will use to multiply that. This is how you will calculate your base case NPV. So I normally say APV. Most of the things has been done already. So if you come to the note, we are not showing you how to generate relevant cash flows. We are not showing you how to calculate the cost of equity ungeared. We've shown you already. But what I've done here, I'm trying to bring them together because some of the students, you find it difficult to bridge the gap between the topics. Now, PV of the finance effect. What will be the cash flows associated with me financing the project? If I have to finance the project, I need to raise the money. When I have to raise money, I might incur an issue cost. Maybe I have to issue shares or I have to issue debt, and I might incur issue cost. So where there is issue cost, it is not supposed to be discounted using a cost of capital that is associated with business risk. It's got nothing to do with business risk. It's associated with financing. Then when I raise money by way of debt, I'll have to pay interest. When I pay interest, it will save me tax. So what will be the tax saved on interest? Okay, and the last one is maybe the project that you're going to undertake, the government is really interested, or some organization might be interested, and they will give you a loan at a subsidized rate or cheaper loan. So also sort out with subsidy. So when they ask you to calculate APV, please, this is your focal point. Ask the question to feed you with information to feed into this. That is the APV. Get my relevant cash flows. Calculate my cost of equity ungeared. Discount the cash flows with the cost of equity ungeared. It gives me the base case NPV. Question, where is your issue cost? I will sort the issue cost. Tax saved on interest. And then the subsidy. When I finish, I add all of them. My APV comes out. So let's go straight to the note, and then we go through other things. Situations where APV is better than NPV. Most questions and APV, the examiner will ask this question. Why is it that APV is better than the NPV? It follows the same argument. When business risk is changing significantly, there's the need for us to separate it from financing. So we have to use APV. Business risk is also called operating risk. When our financial risk is changing significantly, we should separate financing from business. And we said when the financial risk is changing significantly, it means our debt equity proportion is changing significantly. And the debt equity proportion is what we see in the capital structure. So instead of the examiner saying the financial risk changing, we can say our debt equity or the capital structure is changing. Then where there are subsidized loans or grants associated with the project, where there are complex tax situations, different tax rates for different cash flows, we have to use APV. And where there is issue cost, okay, in raising money. Now be with me. Most of the questions that comes in APV, examiner is not going to tell you calculate APV unless you are lucky. Most of them, the examiner is going to create a scenario, and it's investment appraisal scenario, and the requirement is going to be assess the project on financial ground as to whether they have to accept it or not. And then further, the examiner is going to ask you to discuss why you use the method you use to appraise that investment. Okay, so when the examiner don't specifically tell you which investment appraisal method you should use, Okay, when the examiner don't specifically tell you which investment appraisal method you should use, okay, then you have to choose between APV or NPV. If you read the question and you see issue costs, you see subsidized loans, okay, then the examiner is hiding the APV. If you don't see issue costs, you don't see subsidized loans and all that, and he doesn't give you any specific method to use, you calculate your normal NPV and go. So when you read the scenario, you see issue costs, you see subsidized loans and all that, and a specific method is not asked. NPV cannot be used because APV is better in that situation than NPV. So let's go to the next. Calculating APV. This is what I have explained for you. Calculating the APV, you need the base case NPV and the PV of the finance effect. You need present value of tax saving, issue cost, and the subsidy. This is what I have done on the flow chart for you. Okay. For the sake of our time, I'm not going to do this simple question. I'm going to use the time to do a past question that will cover all of them at the same time, okay? Because you're not going to get something small like that. Okay, right, so you can have a look at that. By the time that we do the other one, you should be able to do this basic one. So let's make time for the bigger one. Issue cost, okay? What the note is trying to do here for you is, as I told you earlier, is that to calculate the base case NPV, everything has already been taught. Everybody knows how to calculate the relevant cash flows. Everybody knows how to calculate the cost of equity of Angered. The only bit that you haven't seen is the issue cost, the tax saved on interest, and then subsidy. Okay, so we're going to take them one and explain how to do the issue cost, how to get the tax savings on the interest and the subsidy. When we finish, we take the past question to summarize all of them so that you see how the APV operate. So issue cost. What is issue cost? In order to raise money to finance the project, we would have to incur what? A transaction cost, and that is what is called issue cost. Issue cost, unless otherwise stated, is supposed to be paid upfront because you have to raise the money before you start the project. So issue cost, unless otherwise stated, should occur in year zero. Issue cost should occur in year zero because you have to raise the money now. And I need the present value of the issue cost. What is the present value of a cash flow in year zero? Is that same cash flow. So if the question tells me the issue cost of raising the money is $200, full stop. As long as nothing is said, the assumption is this is going to be in year zero. If it is in year zero, PV of anything in year zero is that 10. So I'll go and put minus 200 because it's a cash outflow. That's it. However, the problem is when the examiner gives the issue cost as a percentage. When he gives it as a percentage, you need to read the question well because this issue of margin and markup comes in. So let me illustrate. So when he tells me that issue cost is, let's say, 10%. If issue cost is 10%, 10% on what? What ACCA P4 questions are doing is the 10% can be based on amount required, or it can be based on amount raised. Instead of amount raised, sometimes they say gross amount required. Gross amount required. Okay. Now, this is the common sense. If I need 1,000 to finance the investment, it means the amount required is 1,000. And to raise the 1,000, I would have to incur issue cost of, let's say, 100. It means I do not have to raise 1,000. I have to raise 1,100. So that when I raise the 1,100, I pay off the 100, it will be left with 1,000 in my hand. So amount required plus the issue cost should give you the amount what raised. So when he tells you that the issue cost is 10% on the amount required, that is easy. You apply it straightforward. But when he tells you it's 10% of the amount raised or the gross amount to be gross amount required, then you have to do that small proportion. Okay, so this is what we're going to use the example here to illustrate. A project requires immediate capital expenditure of 20 million. The amount is expected to be raised from a 1-for-3 right issue at a price of £22 per share. Right issue costs are 5% of amount raised. Assume a risk-free rate of 10%. Calculate the issue cost that should be included in APV calculation. Assuming A, the issue cost is not a tax allowable expense, the issue cost is a tax allowable expense, and tax is paid 1 year in arrears. Corporation tax rate is 30%. Okay? Okay, so that is the case. Now, I would have to emphasize, so far as P4 is concerned, the A is the most common one. The B, they haven't tested it in P4. It was tested in the old syllables. But we are teaching you, we are preparing you for the exam. We don't know. So whichever one that will come, you should be comfortable. But as I said, the A is the most common one that we have to. Okay, so now let's see. The amount we need to finance the project is 20 million, and this represents the amount required. So if I need 20 million, I would have to raise some amount which is more than 20 million, pay off the issue cost, come and get 20 million to finance the project. So the percentage is said to be 5% on the amount raised. So if the amount raised is what the 5% is based on, then in simple terms, we will have to say that this 20 is the required. So we said required plus the issue cost should be equal to the amount raised. So if issue cost is 5% of the amount raised, the amount raised should be 100%, and as such, the amount required should be 95%. So that 20 million should be 95%, and as such, if the 20 million is 95%, how much will be the 5% issue cost? That is what we did here for you. So it's going to be the 20 million multiplied by 5 divided by 95, and your issue cost is this. So it means technically, you would have to go and raise 21.05. Pay off 1.05, and then the 20 million will be left. Use it for your investment. What will be the present value? We said PV of the finance effect. As long as nothing is said, we assume this is happening in year 0. A cash flow in year 0, what is the present value of it? It's the same as that. So the PV of the issue cost you have to include in your APV calculation is just 1.05. Okay, so issue cost normally is for 1 mark. You should be able to go through straightforward, and then you should be able to get a 1 mark. Next, B, if the issue cost is a tax allowable expense and tax is paid 1 year in arrears, what will be the present value of it? We need present value of cash flows associated with issue cost. So what did we say? We said the issue cost is 1.05. There is tax of 30%. So if there is tax of 30%, 30% of the issue cost will save us tax of 0.315. We need the present value of it. So year 0, this is the issue cost, and that issue cost is 1.05. Then the tax savings is 0.315. Tax is paid 1 year in arrears. Where should I put the tax? Somebody can decide to put it in year 1. Somebody can decide to put it in year 2. So far as this question is concerned, I am happy. It's just the same as what we learned and tax savings on capital allowances. It depends on when that expense will hit the income statement for the calculation of the profit. So if the project is done at the beginning of accounting year, I would have put this one in year 2. If the project is started at the end of accounting year, year 1 is the same. So it's following the same principle as what we learned in capital allowance. If the examiner don't state anything, it's your choice, okay? But normally, if they don't state anything, people tend to put it in year 2. But as I said, whatever you do, they have to accept it because you are making different assumptions, okay? So we put the tax savings in year 1. Now be with me. Where I am concerned is the discount factor to be used. APV told us that cash flows from financing effect are supposed to be discounted using the discount factor associated with the risk that goes with those finance effect. What will be the cost of capital associated with the risk and issue cost? The idea was brilliant, but how will you calculate the cost of equity associated with the risk, with the issue cost? APV was not able to give us an answer. Therefore, for the financing effect cash flows, you are going to assume that the discount factor for discounting those finance effect cash flows is either the risk-free rate or cost of debt. So this is the confusion you are going to be seeing in the revision kit and ACCA website and APV. You will see the same question in one textbook or one revision kit. They are discounting the finance effect cash flows using free cash flow. That same question, another book is dealing using cost of debt. All of them are right. Don't confuse yourself. Or don't you use the risk free, you look at the answer, they use cost of debt and you think you are wrong. No, because APV couldn't tell us how to calculate the cost of capital to discount the cash flows associated with the financing. So it makes assumption that we should either use the risk-free rate or we should use the cost of debt. Okay, whichever you will use is your choice. APV couldn't tell us. So here they were discounting using the risk-free rate given. They were discounting using the risk-free rate. So somebody can tell himself or herself, I am going to use risk-free rate throughout. Somebody can say, I want to use cost of debt throughout. It's your choice. Okay, so that is another confusion and APV solutions. Now this is issue cost. So when you discount it at 10%, you will get issue cost of 0.67764. And that gives you a minus. Issue cost automatically going to give you a minus. Now let's see the tax savings on interest. Let's see the tax savings on interest. We also said another cash flow associated with the finance is that when you raise the money by way of debt, you would have to pay interest. And we all know interest is a tax allowable expense, so it should save us tax. My value should increase by the present value of the tax savings I would have to make. So how do we calculate that? Let's take this example to illustrate. A project requires immediate capital expenditure of 20 million. The amount will be raised through a 10% bank loan over a period of 5 years. Tax is paid 1 year in arrears at a rate of 30%. Required, calculate the present value of tax shield, assuming a 10% interest on the 20 million per annum. The amount will be paid in equal installment over 5 years. Once again, I have to tell you, so far so good, all the APV questions and the tax savings on interest associated with requirement A. But this 212 has been tested in the previous one before. So we are giving you the base. Whichever the examiner decides to do, you will be okay. Because normally, when you go in for the loan, okay, you don't pay only interest. You have to pay in installments. Some goes towards interest and some goes towards the principal. So that is what we are trying to do here for you. So if I am going to start with the A, which is 10% interest on the 20 million, it means every year I would have to pay interest of 10% on that 20 million. I'm not interested in interest. I want the present value of the tax savings on the interest. But to get that, I will need to get my interest first. So what is my annual interest? Every year, I will pay the 10% of that 20 million, which is going to give me 2 million. Tax savings is the tax rate multiplied by that expense, and interest as an expense of 20, and there's a tax rate of 30%. So my tax savings is going to be 0.6. What is the argument? Every year, over the length of the period I have to borrow the money, I would have to be saving tax of 0.6. I need the present value of it. This is 0.6 every year. I have got an annuity. So what discount factor should I use to get the present value of this 0.6? Same argument as issue cost. APV couldn't tell us what discount factor we should use for the cash flows associated with the financing effect. Therefore, you assume either the risk-free rate or you assume the cost of debt. It's your choice again. Okay, therefore, when we come here, we are assuming the cost of debt of 10%. I need the PV. How many years is the debt supposed to go? 5 years here. So if it's for 5 years, then I need the annuity over the 5-year period. However, question told us tax is paid 1 year in arrears. So year 1 tax savings should go to year 2. So I'm going to have year 2 up to year 6. So year 2 up to year 6 is what I'm going to save 0.6. And everybody knows how to do the annuity. So if I assume the 10% as the discount factor, I will pick 10% 6 years and I will take 10% 1 year out. 10% 6 years annuity is 4.3. 55 minus the 10% annuity 1 year, and that gives me 2 to 6 years. We've done this in chapter 2 when we're doing the free cash flow 10. And then every year, the constant cash flow of the tax savings is 0.6. When you multiply, it should give you the PV of it. And this is what you would have to include as your APV calculation. Now let's look at the B. The amount will be paid in equal installments over 5 years. Okay, just as you did in your leasing when you were doing your International Accounting Standard 17. That is what you did. We give you the rent. If it's a finance lease, the rent you pay, some goes towards the interest, some goes towards the principal. What we want to achieve here is the present value of the tax savings on the interest. So if I'm going to pay the loan in installment, every time I pay installment, some goes towards interest, some goes towards what? Principal. So subsequently, my interest is going to be reducing because I have paid some towards that principal. So my interest is not going to be the same. No, you can't pick annuity of 7 years because it doesn't go to 7 years. You can't pick annuity. It's from year 2 up to year 6. Even though it's for 5 years, it doesn't mean you can pick anyhow because you are getting it in year 2, you are getting it in year 3. You can't say, oh, because it's 5 years, I'm picking from, let's say, year 15 and I will take year 9 out. No, it doesn't work like that because you get it in year 2, year 3, year 4, year 5, year 6. So here it's going to be 0.6, 0.6, 0.6, 0.6, 0.6. Tax is paid 1 year in arrears because year 1 tax will go to year 2. Year 2 tax will go to year 3. Year 5 tax will go to year 6. So it can't go to year 7. No way. The project is for 5 years. So why are you going to year 7? Okay. So this is how the cash flows will be, and the tax. Year 1 tax savings will go to year 2, and as such year 5 will go to year 6. So you cannot go to year 7. Okay, so that is how it should be. Now let me come back to this. So every year you are going to pay some installment, and that installment will be paying towards interest and principal. The question here is, how are we supposed to calculate the installment? Because they didn't give us the installment. And let me bring your mind on something. If you look at the June 2014 exams, the examiner tested duration, bond duration, which is Frederick Macaulay. And then he said the amount will be paid in equal installment over the period. And we all know duration, we would have to come out the discount, number of years on average, weighted average, and we said is the mean. So we need to get the cash flows every year and discount it using either the cost of capital or the internal rate of return. So what will be the cash flows? Because we are paying it in installment every year, we were not getting interest, and then finally principal. Okay, and he didn't give that annual installment. How will you calculate that annual installment? Everybody knows it, but whilst we are learning, we don't bring our minds on. Okay, so what I'm going to do, you don't need it only when you are doing APV. You need it anywhere. You have to calculate annual cost. Okay, at our F9 level, we all learned equivalent annual cost. And we said equivalent annual cost is equals to the present value divided by the annuity factor. So if I have to borrow 20 million, at an interest rate of 10%, how much should I pay annually? What will be the annual cost to me? So that whatever I will pay plus its interest, come the end of the 5-year period, is equals to 0. All what you need is that equivalent annual cost. So what is the present value? What is the amount you are borrowing? I am borrowing 20 million. If I'm borrowing 20 million, I have to divide it by the annuity factor of what? The interest is 10% for how many years? 5 years. So go to your annuity table, pick 10%, 5 years, and that is what is giving the 3.791. So if I've got 3.791 and I divide the 20,000 by that, this is my annualized amount. So anytime that they want to get the annualized amount, it's just like annuity. If I give you the years, year 1 to year 6, and I tell you this is the cash flow, let's say 20, discount factor, you bring annuity factor 4.1. This is the PV. 4.1 times this is going to give you about, is it 82 or something? And if I give you this 82 and I give you this and I tell you to calculate the annualized amount, you should be able to divide this by that to get this. So that is basically the case in there. So anytime you need the installment, you have to think of the equivalent annual cost. So every year we are going to pay 5.3. So what will be the interest element? Year 1, at the beginning of it, you went in for 20 million. Come the end of the year, you have to pay interest of 10. So you are owing the bank manager 22, but every year you are supposed to pay the bank manager 5.3. I will pay 5.3. So at the end of year 1, this is what is the balance left, which will be the beginning. 10% of that, pay your 5.3. This is the end and beginning. 10% of that will give you 1.3, just as you did and your leasing. And this one, you pay your 5.3, you get that. Beginning, that is that. 10% of it, pay your 5.3, you get that. Beginning, pay your, the interest, pay your 5.3. Come the end of the 5th year, it should be equals to what? 0. What are we interested in? We are interested in the tax savings on the interest. So we have to pick up the interest, and the interest that we have to pay over the period is what we have got here. So let's move on to the next. Year 1 up to year 5, the interest that we calculated up there for the respective years are this. Tax savings, as we said, is always the tax rate multiplied by the expense. So giving me this interest, giving me the tax rate of 30%, we multiply the interest by the tax rate. But interest is paid 1 year in arrears. So year 1 should go to year 2, and as such year 5 will go to year 6. So this is how we get the figure. So 30% of these interest years should give you the tax savings on that. And when you get the tax savings, we want the present value, which in this case is 10%. This present value discount factor we need, APV couldn't tell us. So as I said, you can either use cost of debt or you can use what? The risk-free rate. We are using cost of debt here, and then we get a 9%, 10% from the table. Discount these two, and you get the present value. And that present value is what you have to put in your APV calculations. So this is how it is. But as I told you, the first one is the common one, because that one, the interest is paid on a straight line. But the second one, because you pay installment, some will go towards interest, some will go towards principal. So subsequently, your interest is supposed to be decreasing. Get those interests, multiply by the tax rate by it, and then you get the tax saved, and then you find the present value. The sum of it is the present value of the tax savings and interest added to your APV calculation. The last bit is the subsidy. The last bit is the subsidy. Okay, what is subsidy? Subsidy, sometimes they will call it a cheap loan. When you have to undertake the project, as we said, you have to raise money. By raising the money, it is possible. Okay, how tax save in year 0 is 0. I mean, year 1 is 0. You are not going to get any tax savings in year 1. Why? Because the tax is paid 1 year in arrears. So your year 1 tax that you saved, you won't get it in year 1. You would have to get it in year 2. So this year 1 is what is come toward year 2. So we are moving it like that. Okay, so year 1 will go to year 2, and then year 5 will go to year 6. Just as you were doing your MPV calculations. If tax is paid 1 year in arrears, do you get any tax paid in year 1? No. Your year 1 tax will go to year 2. Okay, brilliant. Right, so let's see the subsidy. Let's see the subsidy. When you are financing the project could be financed by a loan. And when you are going in for the loan, for the sake of maybe government being interested in the activity that you're going to do, the government might give the loan to you at an interest rate which is less than the normal rate. And that is what we say the loan is subsidized. So for instance, if the normal interest rate is 10%, government says, okay, you pay something like 7%. So if it is 7% that you are paying, something you ought to have paid 10, you paying 7, you are saving what? 3%. And that 3% is what we see as the subsidy. As long as you save that money, your cash flows goes up, because that money was supposed to have been paid and you didn't. So if your cash flows goes up, what should happen? We need to increase our value by the present values of whatever savings that we made. Okay, so this is what we're going to look at. Okay, a project requires immediate capital expenditure of 20 million. The company normally borrow at 8%, but the government loan will be available to finance the project at 6%. Assume a risk-free rate of 5% and that the project is expected to last for 5 years. Tax rate is 30%. Calculate the present value of tax shield and present value of subsidy. Point of attention, as long as there is subsidy, unless it is 100% subsidized. As long as there's subsidy, if it is not 100% subsidized, then tax savings on interest is applicable. Okay, what I said here is you normally would have paid 10% and you are paying 7%. That 7% that you are paying, it should save you tax. So we have to get the tax savings on this. So the first interest, tax savings on interest is applicable before you come and sort out the subsidy, which is the 3%. Most students or some students are not able to do the 2. Their subsidy, they only handle the subsidy and they forget about the fact that I am still paying interest of 7%. So when it is subsidized, unless it is 100% subsidized, which I haven't seen any question that the examiner will do that. So as long as there is subsidized loan, you will pay some element of interest, and that interest that you pay should save you what? Tax. So watch out for it. Okay, so now let's sort them out. I was supposed to get the money by borrowing at normal 8%, but it's going to be subsidized and I would have to pay 6%. So the 6% I am paying, I would have to pay, or I have to save interest on that. So what will be the annual interest I have to pay? I borrowed 20, instead of me paying 8, I'm paying 6, so I'll pay interest of 6. So 6% of the 20 million. And when I get this 6% of the 20 million, that is the interest. I am not interested in the interest per se. I want the present value of the tax savings. So what will be the tax saved? The expense multiplied by the interest rate. I get, the tax rate. I get the tax saved. When I get the tax saved, then I need the present value. How many years? They said 5 years, so I will need the annuity factor. What discount factor should I use? Once again, APV couldn't tell us all the finance effect, issue cost, tax savings, and then subsidized loans. APV couldn't tell us. So choose risk-free or choose cost of debt. My advice is that the one that you would choose, be consistent. If I decide to use risk-free, all the three, I'm using risk-free. If I decide to use cost of debt, all the three, I'm using cost of debt. That's it. Don't swap between them. Just choose one and go with it. If somebody also choose the other, that is fine. This is the major criticism of APV. So examiner will give you the full mark. Okay? So we were using the risk-free rate here. So what will be the PV of it? This 0.36, I will receive it for the next 5 years. But this question didn't tell us tax is paid in arrears. So we are assuming it's paid in relevant years. So I'm picking 10%. Is it 10% risk-free? Okay. Let me see. Yes, risk-free is 5%. So 5% risk-free, how many years? For the 5-year life. So if you go to your annuity table, 5%, 5 years should give you this. You multiply by that, and this is the present value of the tax savings on the interest. You add it to the APV. When you finish, then you come and sort out the subsidy. What is the subsidized effect here? You were supposed to have paid 8%, but you paid 6, so I'm saving 2%. So 2% multiplied by the 20, this is what I'm saving every year. However, remember this, when you pay less interest, you were supposed to pay 8, you paid 6. It means your interest is less. When your interest is less, your taxable profit will be more, so you will pay more tax. So you don't save the whole 2%, you save net of tax. Because if my profit before interest and tax is 1,000 and my interest, instead of let's say 80, my interest I paid is let's say 60. What has happened? This one will give me 920. This one will give me 940. Assuming tax is 10%, this is 92, this is 94. What is the gap? The gap is that I am paying extra by 2. So here I'm saving 20 here, but here I am paying extra 2. Therefore, I am not saving 20, I am saving 18. Okay, so this is how it should be. So your net subsidy is what you need. Watch out. Some people forget about the tax. That is why I've done this for you. Okay, so the net savings, I am not saving the whole of the 20, because when I save the 20, it has got a tax implication. So I will save net. So if tax is 10%, I will save 90%. 90% of the 20 is going to give you the 18. And that is what we are doing here. So I saved 0.4 gross, but there is tax of 30%. I will save 70% of it, and I have to use the annuity factor just as we did. But remember, either cost of debt or risk-free, and that will give you the total, and then you use it for the APV calculations. Now let's take the practical problems, and we take a question to summarize everything. The first practical problem of APV, as I keep telling you, when somebody asks me to discuss problems of any model, I look at what I do. If you ask me to calculate APV, this is what I will do. What are the problems in here? The first problem we can think of is that we need the cost of equity and yield. And to get the cost of equity and yield, we are using Miller and Modigliani, either preposition or B-test. Miller and Modigliani, is it a perfect theory? No. It has got so many assumptions. Risk-free rate, it has got assumption that companies in the same industry will have the same business risk. So it is a problem. Next, when I was calculating the PV of the finance effect, Was I able to calculate a cost of debt or a cost of capital to be used here? APV couldn't tell us. All what APV told us is that, okay, it's good for you to separate them, finance and business. However, how to discount these cash flows? We are assuming that we should either use risk-free rate or we should use cost of debt, because APV couldn't tell us the method we can use to calculate the cost of capital associated with the risk of issue cost, associated with the risk here, associated with the risk here. It couldn't tell us, so that is another problem. APV sometimes become complex by you being able to come out with all the cash flows associated with it. But what I will say to you in the exam room is, when they ask you to talk about the problems of the evaluation that you've done, you are not going to limit yourself to those ones in the note, because to get your relevant cash flows, you need to think, I would have to use inflation, I would have to use units, I would have to use number of years. How can we assume that the project can last for 5 years? It's a problem, because it might last for 3 years or it can last for more than 5 years. So criticize the number of years, criticize how you got the cash flows, inflation and all that. Criticize the tax rate. Are you assuming tax rate is going to stay there for let's say 30% for 5 years, 6 years? So you look at all the assumptions in the question and then you discuss them. In addition to that, you come and discuss the fact that you have to calculate cost of equity, and that cost of equity, it has got problems because of Miller and Modigliani. How do you get the discount factor for the finance effect? Okay, so have a look at all that. You don't restrict yourself to only this. No, you have to bring the way you got the cash flow, the way you got the cost of equity, the way you did all of them. And the question in front of you should give you the basis. Okay, now let's take this example to illustrate. Estimate the adjusted present value, APV, of the proposed investment. Comment upon circumstances under which APV might be a better method of evaluating a capital investment than net present value method. We all know that. We said APV is better when business risk is changing significantly, financial risk is changing significantly, there are subsidized loans, there are complex tax situations, there are issue costs. So I am going to say this bit should be book work. Okay, that is what we see up there. Now I have to calculate APV. If I have to calculate APV, my advice to you is, this is how you have to look at it. So this should run quickly in your mind. I need the base case NPV, and the base case NPV should be the relevant net cash flows discounted using cost of equity. I need to get issue costs. I need to get tax savings on interest. I need to get what? Subsidy. Question, where are these? That's it. Question, where are these? Now let's go and read the scenario. The question should be giving you the answers. The question should be giving you the answers. If you have told me to calculate APV, I need relevant cash flow, where is it? I need cost of equity and geared, where is it? I need issue cost, where is it? I need tax savings, where is it? I need what? Subsidy, where is it? Question is supposed to give you those answers. So let's read. The managers of Straya Incorporation are investigating a potential 25 million investment. The investment will be a diversification away from existing mainstream activities and into the printing industry. Don't read it like a storybook. We are diversifying. And as long as we are diversifying, our current business risk is useless. We need to get a business risk in the industry where we are diversifying to. Where are we diversifying to? Into the printing industry. 6 million of the investment will be financed by internal funds, 10 million by right issue, and 9 million by long-term loans. The investment is expected to generate pre-tax net cash flows of approximately 5 million per year for a period of 10 years. The residual value at the end of year 10 is forecast to be 5 million after tax. As the investment is in an area that the government wishes to develop, a subsidized loan of 4 million out of the total 9 million is available. This will cost 2% below the company's normal cost of long-term debt finance, which is 8%. Okay, Straya's equity beta is 0.85 and its financial gearing is 60% equity, 40% debt by market value. The average equity beta in the printing industry is 1.2 and the average gearing 50% equity, 50% debt by market value. The risk-free rate is 5.5% per annum, and the market return 12% per annum. Issue costs are estimated to be 1% for debt financing, excluding the subsidized loan, and 4% for equity financing. These costs are not tax allowable. The corporate tax rate is 30%. Calculate APV. So if I have to calculate APV, I need my base case NPV. Where is the relevant cash flows? Question told me the initial investment will be 25 million, and it's telling me that I will finance it 6 million, 10 million, and 9 million. That is how I'll finance it. The cost is 25 million. Okay. Then it's telling me the investment is expected to generate pre-tax cash flows of approximately 5 million per year for a period of 10 years. Pre-tax. Then the residual value after tax is 5 million. Okay, these are the cash flows. Okay, so what will I do? Let's go straight. That is what we did here for you. So we will start year 0. We invest initial investment, which is the 25 million. Year 1 to year 10, because the cash flows are constant, I'm using annuity. Every year they said pre-tax net cash flow is going to be 5 million. Tax is 30%, so I will get net of 70%, which is 3.5. And come the end of year 10, I would have to get the residual value. And the residual value they said is 5. This is the cash flows. Don't use this one to judge. Even though this is a past question, the notes is prepared that we know how to generate cash flows normally. So the examiner could have given you selling price, inflation, units, variable cost, inflation, fixed cost, everything for you to come and get every year the 5 million net cash flow they've given before tax. So when I get the cash flows, my next question is, as long as these cash flows are from operations, I'll have to discount using a cost of equity in all equity situation, or cost of equity ungeared. This is where we are. This is where we are. I've got those cash flows. Now I need cost of equity ungeared. That cost of equity ungeared, which one do I have to use? Do I have to go per position, or do I have to go beta? The question should tell me. I ask the question, do you want me to go beta? Do you want me to go per position? Question will tell me, Fred, I have given you beta. So as long as beta is given, examiner is expecting me to go towards the beta. Then I ask, okay, if you have given me beta and I'm diversifying into the printing industry, then what should be my proxy beta? My proxy beta is supposed to be picked from that industry. They said my current beta, Streyer's equity beta, is 0.85 and it's 60%, 40%. Do I care? I don't care about that because I am diversifying. Once I am diversifying, I need a proxy beta in the area I'm going in now. I'm going to the printing industry, so I need to pick my proxy beta from the printing industry, which they said is 1.2. And when I pick that proxy beta, I need to ask myself, that proxy beta, are you equity beta or are you debt beta? Question said equity beta. Once it's equity beta, it could be geared or ungeared. This is how you have to be interacting. Once it's equity beta, it will be geared or ungeared depending on where I'm bringing it from. I am bringing it from industry that is having debt of 50%. Therefore, that equity beta is geared. If the examiner has said, oh, the asset beta is 1.2 and they are having gearing of 50% debt and 50% equity, that as long as it is asset beta, it's measuring only business risk. There's no need for me to ungear again. So when you are picking these figures, you have to be analyzing them. Otherwise, when the examiner hide a trick, you won't pick it. So here they said equity beta. So once it's equity beta, this 1.2 could be geared or ungeared. And because the company or the industry is having debt of 50%, this is geared. If it is geared, it's measuring both business and financial risk. What should I do? I have to remove the financial risk to get the asset beta that measures only the business risk. So that is what we did here. Okay, so in order to ungear, we will say, get this asset beta, the 1.2, equity is 50, debt is 50, debt is 50, equity is 50, tax rate is 30%, and this is your asset beta measuring the business risk. And when I was explaining, I told you, as long as it is APV, there's no need for you to re-gear because we don't need any financial risk. Even though our company is geared, we don't need that financial risk because we are doing APV. We need only cost of equity associated with business risk. Therefore, put it straightforward in the capping. And when you put it straightforward in the capping, it gives you your cost of equity ungeared. And once I got the cost of equity ungeared, there's no need to go to work because that is what you're looking for. Cost of equity ungeared, that is the 10%. You go through your table and then you discount. And this is your base case MPV. This is your base case MPV, okay? Now, if you are done with your base case MPV, there is the need for you to look at the financing effect. Ask the question, have you got issue costs? So let's go and read. Question told us there is issue costs, there are subsidized loans, there is what? Interest to be paid. So we have to sort out the issue costs, the tax savings on interest, and then the subsidy. Where is the issue cost? This is where the examiner gave information and issue costs. Issue costs are estimated to be 1% for debt financing, excluding the subsidized loan, and 4% for equity financing. Okay, he didn't say gross amount or required amount. He said equity finance and debt financing. Indirectly, he's telling you on the required. Therefore, my debt financing is 1% of it, excluding the subsidized loan. The total debt is 9 million. If you can see it here, the total debt is 9 million. And they said out of that 9 million, the government is going to subsidize 4 million. So a bit of the 9 million is not subsidized. It's what we have to pay the issue cost of 1%. So 4 from the 9 should give us the 5. And then the equity. Equity, we are financing internal by 10 million, and then internal by 6 million, and right issue by 10 million. Internal fund is equity. Right issue is equity, so equity should have been 16. However, internal funds are not supposed to be issued. Therefore, there is nothing like what? Issue cost. The issue cost associated with equity should be associated with only the right issue. Internal funds like retained earnings, you have it there. It shouldn't cost you any issue cost. So that is 4%. So if you come down here, you're going to see that on the right issue is the 10 million multiplied by the 4%, and that gives you the 0.4, and then the 5 million debt, which is not subsidized, is 1%, and this is your issue cost, 0.45. This is happening in year 0. Nothing is said whether issue cost is supposed to be paid in year 1 or year 2 or nothing. So your assumption here is that it is happening in year 0. And the question told us there is no what? Tax allowable benefit to be got here. So therefore, if this is happening in year 0, present value of any cash flow in year 0 is that same cash flow. Therefore, my issue cost for the APV should be 0.45 million. Full stop. Next, we also have to look at the tax savings on the interest. Now, the interest, we have got 2 types of debt. We've got subsidized debt and unsubsidized debt. We've got debt of the 5 million because our total debt should be 9 million. 5 million is coming from normal, and then 4 million is coming from the subsidized one. The normal, our interest we have to pay is 8%. So 8% of the 5 million will give you 0.4. The tax saved on that 0.4 is you multiply the 0.4 by the 30% tax rate. That is giving you 0.12. On the subsidized loan of 4 million, the interest you have to pay is 6%. And that 6% is giving you 0.24, and the tax savings on that will give you 0.072. Therefore, as a result of going in for the 2 loans, I will save tax of these 2. So sum up the 2. When you sum up the 2, you will find the present value of it. So summing up the 2 is what is giving us the 0.192. Now be with me. We need the present value of it. What discount factor should we use? We have to think of using either the risk-free rate or the cost of debt. Examiner will not tell you anything. It's your responsibility to bring that assumption. Okay, it is a major problem of APV. So what your note assumed here is the risk-free rate. The question gave us a risk-free rate of 5.5%. So if it is 5.5%, I need annuity. I need an annuity. And what will be the annuity of the 5.5%? What will be the annuity of the 5.5%? Okay, so this is what we did. Be with me. 5.5% cannot be got from the annuity table because it's whole number. Even though somebody will say, why wouldn't I approximate it to 6% and go? Fine. But what I will encourage in this case, in the exam room, is that we know 5.5 falls between 5% and 6%. So pick your annuity factor 5%, 10 years. And pick your annuity factor 6%, 10 years. Okay? The two, you add them together and you divide by 2. It should give you 5.5 because the 5.5 lies in between the two. So pick 5%, 10 years, 6%, 10 years, and you divide by 2. If they give you about 5.7, you approximate it to 6 and go. Okay, but when they do it at the midpoint, you can just add the 2, divide by 2. So that is what they did here. They pick 5% and then 6%, 10 years, divide by 2. So that 5.5 will lie in between the two, which is the 7.541. And because we are saying annuity, they didn't tell us tax is paid 1 year in arrears, so we move on straight. So we multiply by the annuity factor, and you get the tax savings on the interest for the two debt. Now let's see the subsidy. With a subsidized loan, what is the subsidy? Normally, we would have picked the loan at 8%, as we did up there. We would have picked the loan at 8%, but the 4 million we are paying what? 6%. So we are saving 2%. But don't forget, if you save that 2%, it will force you to pay more tax. So effectively, you would have to pay the net. Okay, so we said the 2% of the subsidized loan, not on the whole 9 million, because the subsidized loan is only 4 million, and that gives you that. And don't forget to knock off the tax effect. You will get the net of it. When you get a net of it, find the present value using the same risk-free rate. And the discount factor annuity we said is 7.541. So we bring the tax, the net subsidy saved, multiply by the annuity factor, and you will get the present value of the subsidy. Once you are done with it, sum up all the figures. Your base case MPV, we said, is minus 1.564. Present value of the tax savings we did. Present value of the subsidy and the present value of the issue cost. Issue cost is a minus figure, remember, because it's a cash outflow. You sum up all of that and you have to get adjusted present value. Conclusion is the same as MPV. If the APV is positive, accept. If the APV is negative, reject. And if the APV is 0, you break even. So this is basically APV. When they ask you in that big question, calculate APV, don't panic. All what you have to do is lead yourself. I need the relevant cash flows. I need the cost of equity and yield. How the examiner will do the relevant cash flows, I can't stand here and say it. But generally, he will give you sales, variable cost, fixed cost, inflation, tax savings on capital allowance. If you are lucky, as this certain what they did, they just give you the net cash flow, you flow with it. So it depends on what the examiner wants to do. If you get the net cash flows, where is the cost of equity and yield? How will I calculate it? It depends on the question. Question, have you given me a proxy cost of equity? If question had given me proxy cost of equity, I need preposition 2. If question had given me proxy WACC, I need preposition 3. If question has given me proxy beta, I need that proxy beta and gear it and put it in the cost of equity formula, which is the capping, and then you move on. Look for issue cost, look for tax savings on interest, and then the subsidy. And that is all about your APV. Okay? So now let's move on to the international investment appraisals. Let's move on to international investment appraisals. Okay, what do we mean by international investment appraisals? Okay, now the hard work is over. The international investment appraiser we're just going to roll over so many things. The hard work is over. I know cost of capital, the APV, and those things are very, very complex because most of those things you haven't met them before. So my advice is you have to get time for them. You have to read it again and again and again, because when you read it first, you will easily forget the following day. Don't be discouraged because it's not part of you. If you do it and you do it again, you all learning curve. You do it now, you do it again, you do it again. It's going to be on the beat for you. Okay? That is the only problem I have with P4. Most of the things we're doing here, most students haven't met them before they join the P4. So it becomes a bit, initially it becomes a bit technical. But the hope is that I've heard it over and over and over, and I know it. Because eventually they are able to go there and pass it. So my advice to you is have a look at them again. When you look at them first, you definitely forget because it's not part of you. Don't be discouraged. Go there again. If you forget, go there again. Subsequently, you see that you're doing them on the beat. Okay, what is international investment appraisals? What is international investment appraisals? I have to say that if international investment appraiser should come in the exam room, you will see it in question number 1 because it's always big. It is the best question for question number 1 for the 50 marker, I have to say. And every time that they've brought it in question number 1, pass rate and P4 is excellent. Okay, why? Because it follows the same investment appraisals that we've done from F9 up to this level. The international investment appraisals occurs when a company is based in one country and they're going to do the project in another country. So let's say I am based in the UK and I'm going to do the project in Germany. This is an international investment appraisal. So whatever we've done so far, I am based in UK, I'm doing the project in UK, that becomes a domestic investment appraisal. Obviously, the examiner is not going to say international domestic. You read the scenario. As long as the company is based in country A and they're going to do the project in country B, it becomes an international investment appraisal. How do we do it? To do international investment appraisals is normal investment appraisals. I can use all the techniques we've used: MPV, APV, internal rate of return, modified internal rate of return, duration, discounted payback. All those techniques are applicable. However, so far as your examination is concerned, it is fighting between MPV and adjusted present value APV. If you read the question and you see subsidies, you see issue costs, then the examiner wants you to appraise the investment on the basis of what? APV, as we said. If you don't see them, then you are doing the normal MPV. Whatever techniques that you will have to do, you need a number of years, you need the relevant cash flows, and you need the appropriate discount factor. Okay? Right. So I'm going to lead you through that. You need appropriate discount factor, you need the relevant cash flows, you need a number of years. Nobody is going to say anything about number of years. Every question is supposed to give to you. Cost of capital, I'm not going to say anything apart from refreshing your mind. If it is MPV method that you are using, when you get the net cash flows, you would have to use the project specific WACC. If it is APV that you are using, when you get the net cash flows, you have to discount them using cost of equity and gear, and then you go and sort the finance effect out. So the methods are the same as we know. The only difference is how to generate the cash flows. So be with me. Okay, I'm quickly going to explain and we take a question to summarize all of that. Okay, now, I am based in the UK, I'm doing the project in Germany. What will I do? The project will be based in Germany. Sales, variable cost, fixed cost, everything will be in Germany. So sales will be in the euro, variable cost in euro, specific fixed cost in euro, tax tax savings on capital allowance, working capital, initial investment, residual value, everything is in euro. So it's like you are doing domestic investment appraisals in Germany. When you get the net cash flows, because the parent company is in the UK, shareholders are assumed to be based in the UK, and the project is done in order to maximize those shareholders' wealth. So when I get the net cash flows in Germany, what I have to do is those cash flows are supposed to be remitted back into the shareholders who are based in the UK. Therefore, what should I do? I have to convert the euros into my pounds. And to convert the euro into pounds, I will need to estimate what? Exchange rate. I will need exchange rate. So you will get your net cash flows normal as we do in Germany or in the host country. When you get the net cash flows, you need to remit them back into your country. And in order to remit them, you need to estimate the exchange rate. And to estimate the exchange rate, you need the purchasing power parity or the interest rate parity to estimate that exchange rate. And when I get the exchange rate done, I will convert and bring it to UK. When I bring the money into UK, picture it, I'm putting in the framework. When I bring the money into UK, the UK taxman will tell me money earned, money brought in are subject to UK tax, so I should be paying tax in UK. However, most countries, there are double taxation agreements between them. So if such agreement is there, you are not supposed to pay tax twice on the same word, income. Therefore, if there's a double taxation agreement between UK and then the Germany, I would have to pay the extra. So sort out that double taxation, which I'm going to take you through. Sort out that double taxation. When you finish, is there any other cash flows associated with the project in UK? Sort that one out. Maybe is there a lost contribution or whatever as a result of doing the project there, and come and get the net cash flows in pounds. When you get a net cash flow in pounds, if it's NPV, discounted using the project-specific WACC. If it is APV, discounted using cost of equity and geared, sort out the finance effect, and you get your APV, and you take it from there. Okay, so let's quickly go to our note, and then I bring your mind on this. This is what I have explained. All the cash flows, get it in the host country, remit it back to your country, come and sort out tax, come and sort out all the necessary other cash flows in your country, and then discount it with the appropriate discount factor, get a NPV, cost of equity, and get APV, sort out with the other cash flow items. Project. Are we supposed to look at the project from the parent or the project viewpoint? We have to look at it from the point of view of the parent, because that is where the shareholders are. That's the reason why we have to bring the money back into our country. So this, don't bother yourself to read it. All what we are trying to tell you there is that when you are doing the project, you would have to bring the money back to your country. We don't calculate the NPV in euros, because our shareholders are not in euros. Their wealth is in pounds. So bring it in pounds. Okay. Then taxation and international investment appraisals. That is what I was trying to explain. Your note is trying to give you some small understanding before we take a question to summarize. Taxation, international investment. If I'm doing the project in Germany, my asset will be in Germany, so I should be entitled to Germany capital allowances. I should pay tax in Germany. Okay, so you pay your tax in Germany, you save your tax savings on capital allowance in Germany. Come and get the net cash flows. If you get the net cash flows and you remit it into UK, that is when the double taxation starts to come in. So this is what we are trying to explain to you here. If I did the project in Italy, and the tax rate in Italy is 20%, it means I paid 20% on the taxable profit in Italy. When tax rate in UK is 20% and there's double taxation agreement between the UK and then Italy, when I bring the money into UK, I don't pay any tax again, because it will cancel out. Because double taxation, you do not have to pay tax twice on the same profit. If it is 30% in Italy and it is 20% in Italy and 30% in the UK. How much should I pay? UK taxman will say, oh, you have paid 20% in Italy, so that 20% should cancel. So I will pay 10% to the UK man. If it is 20% paid in Italy and 18% in the UK, I don't pay anything. UK man doesn't give me anything. The principle is you have to pay the highest rate. So if you pay the highest rate in that country, when you come to your country, you don't pay anything. If you pay the lower rate in that country, when you come to your country, you need to pay the difference. If they are the same, they cancel out. Okay, then another problem is forecasting exchange rate. Okay, another problem is forecasting exchange rate. How do we forecast the exchange rate? Okay, as we said, we can use the purchasing power parity or we can use the interest rate parity. When they give you inflation rate, you have to use the purchasing power parity. When they give you interest rate, you would have to use the interest rate parity. The formula is the same, but my problem with the formula is this. Okay, I normally quote it this way, that my future spot rate is the spot rate now multiplied by 1 plus inflation A divided by 1 plus inflation B. Okay, formula sheet will tell you 1 plus inflation home, 1 plus inflation foreign. Is creating confusion in the exam room. The home and foreign has got nothing to do with you, where you are located and where you are doing the project. That's why I don't want to use it. So be with me. The inflation or interest I will put here depends on the currency I am putting here. If I put euro here, I have to put euro inflation and then pound inflation next. If I put pounds here, pound inflation should go up. So whatever currency you are putting here, its inflation should go up. Okay, and the other inflation should go down, or interest should go up and down. Wherever you see the inflation, you can put the interest. In that case, you say you are using the interest rate parity. And my advice to students is you don't even have to tell the examiner, just code the formula and then calculate. You don't necessarily have to say I'm using the interest rate parity or purchasing power parity. Put them in the formula, calculate the figures, and then you move on. So if we take this example, Start All PLC wishes to estimate future exchange rate based upon the following projections of inflation: UK, USA, Begonia. If current spot rate are US dollars 1.6 to 1 pound and Begonia doll 250 to 1 pound, using the purchasing power parity, what are the predicted spot rate for the currencies concerned at the end of each of the next 5 years? Okay, so what are we going to do here? Okay, if you can do between the pound and then the dollar, you can do between any other two currencies again. So giving us inflation rate, I should be able to use the purchasing power parity to estimate. But as I told you, you can decide not to mention the theory you are using. So this is the formula we are going to use. And if this is the formula, then I will say year zero. What is the spot rate? Year zero, the spot rate between the dollar and the pound is 1.60. Year one, what will be the exchange rate? If I'm in year one, you pick the year zero exchange rate and you adjust it with the inflations. So this is 1.60 multiplied by, this is dollars. Once this is dollar, I will need a US inflation up. US inflation is 5%, so 1.05. UK inflation is 5%, 1.05. If you remember from your F9, you were told, according to the purchasing power parity, a country with higher inflation, its currency is supposed to depreciate. So if we have the same inflation rate, no currency will depreciate. They still have to be at par. So year two, I'm bringing year one figure, which is 1.60 multiplied by inflation of the US, 5% still, and UK 5% still. So this one will be 1.6. Year 3, I will bring the 1.6 again multiplied by US is 7%, UK is 5%. Okay, and that is giving is it 1.63? Why do I have to believe in this 1.63? A currency with higher inflation should depreciate. When a currency depreciates, you need more of that currency for the same amount of the other currency. And because US inflation is 7%, I should expect the dollar to depreciate. And I need more dollar for the same amount of the £1. Then I will say, I will have 1.63 dollars multiplied by US inflation is 7%, and then UK is 5%. It should be expected to be depreciating. So 1.662, and then year 5 will be 1.662 multiplied by US inflation, UK inflation, and that will give you the 1.693. So this is how you would have to estimate the exchange rate. To be honest, international investment appraiser, the only problem I have with it is that you have to move on, because it's like you are doing two domestic investment. You are doing it in the host country, bring the money to your country, and you come and sort it out. Okay, so let me explain all the points, and we'll take a bigger question to illustrate. Project discount factor. This is what I said. What discount factor will you use? If you have to use internal rate of return to appraise that international investment, when I get the overall net cash flows, I have to choose my own two rate, and then I would have to discount them to get two NPVs and get an internal rate of return. If I have to use APV, I need to discount it using the cost of equity and geared. Go and sort the finance effect. If I need MPV, go and calculate project specific cost of capital. Discount the net cash flows. You have got the MPV. Now let's move on to the next. So here, all what I can say here is with the cost of capital is you need the cost of capital that is systematic to or associated with the systematic risk associated with the project. Okay, remission of funds. Okay, this is a duplication. Normally, the examiner is not going to say remission of funds. The examiner is going to say how you will overcome exchange controls. This is the common sense. So if you look at the point here, they are almost the same as the point up there. I am going to explain that. What do we mean by block remittances or overcoming exchange controls? I am based in UK. I'm doing the project in Germany. When I make the cash flow at the end of every year, the assumption is that because my shareholders are based in the UK, I would have to transfer the money from euro into pounds. But the exchange rate is generally determined by demand and supply. And the country that its currency is more demanded will appreciate, isn't it? Therefore, if I'm bringing the money from Germany to the UK, I am going to supply the euro in order to demand the pound. So what will happen? It will force the euro to depreciate against the pound. So the country government, like German government, will say that no, I wouldn't allow you to bring the money at the end of every year, because when you bring the euro, convert it into pounds at the end of every year, you are increasing the demand of the euro, and as such, you will depreciate the euro. So those monies that you get in euro, they are going to block it. They're not going to allow you to bring it from euro into pounds. Okay, they will block it until the end of the project life. Okay, I have to say most of your calculations, they are not going to do that, but maybe he will ask you to write. Okay, so when there's block remittance, how do companies go around it? How do companies go around it? Okay, that is the argument in here. Companies will go around it by creating artificial expense in the subsidiary. So they can say, oh, we are charging them management fee because we have to give them some consultancy, whatever advice. Therefore, if they will see, the subsidiary will see it as an expense, and the parent company will see it as income. So we are going backdoor. So the subsidiary will deduct the management fee, and then that one is not a remittance. They have to pay because they've got a service. They have to pay. It's not remittance from the project. So year one, when they pay the expense as management charges, then they will bring that money to the UK as paying for the management charges. It's not a net cash flow to be remitted. So what happens? The subsidiary treated as an expense, the money in subsidiary will be less. So it's that money that we are bringing indirectly into our country. We can also charge them royalties. We can use transfer pricing. Instead of the cost of a component, we selling to them at £2 in order to charge them more for their cash flow there to be less, we say £10. Whether it is moral or it is ethical, I think you need to ask your PE1 lecturer. He will be in position to explain that one to you better. Okay, whether it is moral or ethical. Okay, but these are some of the strategies that companies are using in order to reduce. So the only thing you need to understand here is we create an artificial expense. We create an artificial expense there. And when it is an expense, it will reduce their net cash flow, so that even if they block it, we have been able to bring most of the money already. Because the more they block it, the more the NPV or the project is going to be less attractive. Simple common sense is, if they block it, if the project is for 5 years and they tell us we can't bring it every year, you can only bring it to your country at the end of the 5th year. It has got two implications. It has got effect on time value of money. And secondly, the exchange rate movement. Okay, it has got exchange rate movement, because you will be bringing it in 5 years time. You have to what? Exchange it at the exchange rate in 5 years time. What is it? Nobody will know that. And then 2, you have to bring it in year 5. So when you bring it into UK in year 5, you need year 5 discount factor. And year 5 discount factor, the longer you go, the lesser becomes the present value and the lesser the NPV will be. Okay, when you get international investment appraiser questions, after you have done all the calculations, which will be about 20-25 marks, okay, the examiner will definitely want you to do other writing. And the common one will be what other factors you would have to take into account in actually deciding whether you have to go to that country in order to undertake that investment. One of them is the exchange rate risk. Because we have to sit down today using the purchasing power parity or interest rate parity to predict the exchange rate into the future. Who knows exactly what the exchange rate will be? Purchasing power parity, interest rate parity theories, they are all based on different assumptions. And obviously, in the future, the exchange rate might not be the same as whatever we estimated. Okay, so if they are not as we estimated, the NPV that we are expecting might not be the same. So the NPV will be sensitive to the exchange rate. So sometimes when you are suggesting some of these things, you can say that the way we generated the cash flows, we would have to build in risk analysis by including sensitivity analysis. How much should the exchange rate change before the NPV or the APV becomes what? 0. You can bring all of them in your discussion. We have to take all this into consideration, because the moment the exchange rate is not in line with what we predicted, the resulted NPV or the APV will also change. The worst case scenario is how much it should change for us to have a 0 or for us to break even. So you can suggest those things in there. Okay, and then sometimes the examiner might ask you to suggest ways they can combat some of those problems. If it is exchange rate risk, should we think of hedging, which we'll see later? Should we think of hedging? Should we enter into swap agreement and all that? Okay, so look at this. These are broad ideas. Political risk. Okay, there's also political risk if you go into somebody's country. For all other things being equal, the law of that land should favor the citizens or the companies in that land rather than you, for all other things being equal. Okay, so what will be the political risk? It's not only coup, maybe change of government through military action or something. Okay, there could be change of government as a result of elections. And elections, new government will come in and might change policies. They are all part of the political risk. One of the questions the examiner asked some time back was that in that country, that question was APV. The government, the ruling government, was happy to give our company subsidized loan. subsidized loan, gave so many tax incentives and so many things, okay, just to attract the companies to go in there. And the requirement, the examiner said, I think the last bit, the scenario, the examiner said that elections are due in 2 months' time or something, or 6 months' time. And the opposition leader is campaigning that when he wins election, he's going to review all the commercial benefit given to foreign companies. So one political risk here is that if the other party wins, he is going to review. So when he reviews, are we still going to get a subsidized loan? Our APV we calculated is positive, and that APV being positive is telling us that the subsidized loan, we got the present value of the subsidized loan. If he comes and change that subsidized loan, are we going to get that PV? No. What will happen to the APV? APV could change to be negative, and the project might not necessarily be the best. So watch out for this. Also, economic risk. Okay, what is the government spending? If the government of that country is embarking on serious austerity programs, and people are being laid off and all that, who are going to buy your product? Okay, so all these are there. You would have to actually look at them. Okay. Okay, so you're going to get, you are not supposed to be doing the sensitivity analysis in here. It's just a part of explanation. Okay, it's just going to be part of what? The explanation. Because it's a cash flow item, so you have to get a NPV with respect to the exchange rate, but you don't have to bother yourself with that. Okay, think about the fiscal risk, tax rate, changes in the tax rate. Some countries, their local industries will pay different, or local companies will pay different tax, and look at all this. So I'm going to ask you to read this bit because our time is up. When I see you, these sources of finance too, you can read them. When I see you next time, I'm going to take the time to look at this Brockway PLC to see how international investment appraisal works. Technically, it is not difficult. The only thing is that because you have to calculate so many figures, you have to speed up. Okay, so thank you very much for your time. Thank you very much for your time. Okay, unfortunately, we couldn't do that question, but just master the international investment appraisal, the process. Refresh your mind on your cash flow generation and the cost of capitals. When I see you next week, we pick the question and then we finish it and we move on to measures and acquisitions. So thank you very much for your time. Any further question, as usual, you can send them to me through the email. Some of you are doing brilliantly. Some of you too, I haven't heard anything about you. So my assumption is that everything is perfect, but it can't be. So please start working, solving questions, because as I told you, they are just new to you. So if you don't practice, you wouldn't see the relationships. Okay, so have a good time, and I'll see you next week.